Imagine your house is on fire. You reach for the fire extinguisher, right? You want to save everything you own. But suddenly, you realize your credit card is completely maxed out. So instead of putting out the fire, you walk outside and sell the extinguisher to your neighbor just to pay off your Visa bill.
Which is, absolutely insane logic to a normal person.
Right. But that deeply counterintuitive logic is exactly what institutional finance did to the gold market today. It is late Monday night, March 23rd, 2026. The U.S. market has officially closed. And looking at the raw data from today's session is honestly it's like staring at the cascading green code of the Matrix.
Yeah, we just witnessed a historic 4 sigma flash crash in the XAUUSD market across the Asian and European sessions, followed almost immediately by a violent whiplash recovery.
Which brings us to our mission for tonight. Welcome to this late night deep dive. We are conducting a forensic, quantitative audit of this market anomaly. We're pulling our data directly from the diary Kang Bendol daily data analytics projection for today.
It was a textbook liquidity slaughterhouse out there.
Oh, absolutely. And before we even look at a single chart, we need a serious tone check. If you are listening to this, you need to take your lucky trading socks and literally burn them.
Yeah.
Throw out the crystal ball. Because if you traded on instinct today, if you traded on a gut feeling, you were swallowed whole by the market.
Precisely. We are operating strictly in absolute mode tonight. And for those unfamiliar, absolute mode means there is zero room for psychological bias. It's a state of total clinical detachment.
No emotions allowed.
None. We rely purely on precise data analytics, probability algebra, and trashing algorithmic liquidity. You have to understand, the market does not know you exist. It doesn't care how much you need a trade to win. It only obeys the math.
So if the math is the only truth here, we have to figure out how gold, literally chapter 1, page 1 of the Safe Haven Asset textbook turned into a total meat grinder today. We need to dissect the corpse of the Asian trading session.
We really do. Because the price plummeted from around $4,500 all the way down to a terrifying absolute bottom of $40.99.36.
Right, and I want to look at the underlying mechanics here, not just the headlines. Because we had a massive fundamental catalyst rolling over from Friday, didn't we?
We did. You're looking at a highly destructive compounding storm. The foundation of this crash was last Friday's triple witching event.
Which is always a volatile day.
Exactly. For the listener, triple witching is when stock options, stock index options, and stock index futures all expire on the exact same day. On Friday, we had $5.7 trillion in options expiring.
Wow. 5.7 trillion.
Yeah. And this forces market makers to aggressively unhedge their positions, which creates massive structural instability. It just drains liquidity from the market.
It basically hollows out the floorboards.
That's a great way to put it. So you have this incredibly fragile, hyper-leveraged market architecture, and then you throw a geopolitical match on it over the weekend. Specifically, the escalating fears of a full-scale retaliation on Middle Eastern energy facilities.
Right, which caused oil to just go crazy. By the time the Asian session opened on Monday, crude oil had spiked violently, gapping up over $110 a barrel.
And here is where the traditional textbooks completely failed the retail traders.
Right, because the standard linear assumption is, war means uncertainty, uncertainty means panic, therefore gold goes up. But we saw a massive liquidity paradox. The institutions didn't buy gold.
No, they liquidated it with extreme prejudice. Which brings us back to your fire extinguisher analogy. Why sell your best defensive asset during a crisis?
Because of the margin call cascade.
Exactly. When oil spiked to 110, institutions that were short on energy or over-leveraged in other equities suddenly faced massive margin calls from their prime brokers.
They didn't have the luxury of holding gold as a safe haven.
Right. They needed pure, unadulterated US dollar liquidity. They needed it to cover their bleeding portfolios elsewhere. So they dumped their gold simply because it was the only liquid asset they could sell fast enough to raise cash.
That is just brutal. Now, I want to clarify why so many retail traders were totally blindsided by this breakdown in normal market correlation. It really comes down to the mathematical models that retail brokers rely on.
Yes, the Gaussian copula.
Right. So for the listener, think of standard risk modeling the Gaussian copula, like designing a bridge for typical everyday rush hour traffic. It maps standard correlations, assuming that in a normal crisis, gold and oil will move up together.
And it works, 99% of the time.
Exactly.
Yeah.
But standard Gaussian models completely fail to predict a 4 sigma deviation. They mathematically smooth out the extreme outliers.
That is a perfect way to put it. To actually see this margin cascade coming, or to even understand it in real time, you needed highly sensitive tail risk models, specifically a student copula.
Which is a whole different beast.
Oh, completely. Unlike the Gaussian model, a student copula designs the bridge for a Category 5 hurricane hitting during an 8.0 earthquake. It's explicitly designed to detect when normal historical correlations completely break down under extreme systemic stress.
And that's exactly what happened.
Yeah, the student copula showed exactly what was happening beneath the surface. The structural correlation between energy spikes and gold buying was mathematically destroyed.
Institutions were dumping gold purely to hoard cash.
And the retail traders who were buying gold based on the textbook simply became the exit liquidity for those institutions.
They were just providing the cash the big guys needed to survive. Just brutal. But moving through the timeline, the narrative flips on a dime. Just as the so-called smart money finished absorbing all that retail panic at the absolute rack bottom of 3099.36, we transition into the European and U.S. sessions.
And suddenly we get a violent V-shaped rebound.
Right. And the spark for this was a news catalyst out of Washington.
Correct. U.S. President Donald Trump announced a 5-day delay on military strikes against Iranian infrastructure, citing productive talks.
Now, obviously, operating in absolute mode, we look at this strictly as an impartial, market-moving data point. We don't take sides.
Never. It is purely a geopolitical variable entering the algorithm. But the immediate effect was that it deflated the weekend panic. Oil plummeted 14% back down to around $96 a barrel.
Right, but I have to push back here for a second. We are sitting here preaching about pure math, algorithmic precision, absolute mode. But if the market only recovered because a politician stepped up to a microphone and announced a delay in a military strike, isn't that just dumb luck saving the market?
I hear that all the time.
But how can you possibly mathematically quantify an impromptu press conference?
Well, that is the ultimate question, right? And it's the exact trap that keeps retail traders poor. You have to understand, the math did not predict the news. The math does not have a crystal ball for geopolitical speeches.
Okay, so what did it do?
What the mathematical models did specifically, our 10,000 iteration Markov chain Monte Carlo simulations, was measure the absolute exhaustion of the sellers.
Let me break that down for the listener. A Monte Carlo simulation essentially runs 10,000 different alternate realities of the trading day based on current volatility and volume.
Right, and what the math proved in the vast majority of those simulated realities was that every single desperate seller, every triggered margin call, and every retail stop loss had already been liquidated by the time price hit $40.99.
I see. It's like counting cards in blackjack.
Exactly. The math told the machines there were literally no high cards left in the deck. The algorithm proved with an 89% probability that the capitulation was mathematically complete at that specific level. There was simply no one left to sell.
So the market was acting like a coiled spring.
Fully compressed by liquidations. The geopolitical news wasn't the engine of the recovery, it was simply the mechanical release latch. The spring was already compressed and waiting at $40.99.
And when that latch was released, the machines took over.
They went into hyperdrive. High-frequency trading, or HFT algorithms, instantly executed massive short-covering maneuvers.
Because the institutions that had heavily shorted gold to raise cash suddenly needed to close those positions rapidly to lock in profits.
Yes. And to map this behavior, we utilize stochastic differential equations, specifically Merton's jump diffusion model.
And Merton's jump diffusion is crucial here because, standard calculus assumes markets move in continuous smooth lines. But Merton's model calculates the math of sudden violent gaps, the jumps.
Precisely. The algorithms calculated that the continuous downward drift was over, and the probability of a violent jump upward was optimal. The machines aggressively bought back their shorts, dragging gold in a vertical V-shaped recovery all the way back up to 4383.75.
Okay, so if the spring just violently uncoiled and wiped out the previous structure, the old map is garbage. We need a new architecture for tomorrow. This brings us to the tactical blueprint.
We do. We need to transition to the exact supply and demand mitigation zones outlined in the Kang Bendol source data.
Right, because if the math proves the panic sellers are gone at $40.99, how do the algorithms calculate where the new traps go?
Well, we are looking at a completely reconstructed price architecture. First, we establish the absolute floor. Extreme demand sits rigidly between $40.99.36 and $41.50.
which was the absolute capitulation point.
Yes, the macro liquidity sweep we just discussed. Barring a new, unforeseen declaration of war, the probability of testing that absolute bottom again in the near term is incredibly low. That is the institutional accumulation zone.
But that's way too wide for a precision entry. Where is the actionable trap for tomorrow's session?
For an actionable entry, we isolate what is called minor demand, mapped precisely between 42.50 and 42.78. This is the tactical target for a highly precise buy limit order.
Let's actually explain why 42.50 is the magic number. If you map the price action of this crash and recovery, this specific area forms the right shoulder of an algorithmic Quasimodo pattern.
Yeah, the Quasimodo pattern is fascinating.
And if you're listening to this and picturing a hunchback, let's clarify what that actually means on a pricing chart. A Quasimodo pattern isn't just a shape, it's a visual record of institutional manipulation.
It really is.
It shows the market creating a fake support level, the left shoulder then deliberately breaking it to hunt retail stop losses. That forms the head, or the absolute bottom. Then it aggressively recovers. The right shoulder at 42.50 is the exact point where institutions will step back in to defend their new long positions.
Exactly. It's a footprint of liquidity engineering. Furthermore, that 42.50 level is perfectly bolstered by a 0.236 Fibonacci retracement drawn from the crash data.
And the Fibonacci sequence isn't magic.
No, not at all. It is simply the mathematical representation of natural algorithmic retracement. When you overlay the Quasimodo structure with the 0.236 Fibonacci level, you have a 75% probability bounce zone.
Okay, so we have our floor, and our trap is set at 42.50 to catch the pullback. Looking at the upper bounds of the data, I'm seeing extreme supply mapped between 44.77 and 45.36.
Yes. Specifically, the blueprint dictates placing a macro sell limit order exactly at 4,500.
Now, that 4,500 level was rock-solid support last week, and now it looks like an ironclad resistance ceiling. But I have to ask, why are we capping our expectations there? If the geopolitical panic is deflating, why isn't the math projecting a full recovery to 5,000?
Because of the macroeconomic shadow hanging over the entire financial system, you have to factor in the inherently hawkish stance of the U.S. Federal Reserve.
Ah, right. The rate cuts.
Exactly. The weekend energy spike, even though it cooled off today, served as a violent reminder to the market that inflation fears are still very real and they're very sticky. Because of that, any lingering hoax for early 2026 interest rate cuts have been completely priced out of the market.
Right. And this really comes down to the fundamental physics of capital. Gold yields absolutely nothing. It doesn't pay a dividend. It doesn't generate quarterly earnings.
Exactly. When interest rates stay high, the opportunity cost of holding a non-yielding asset like gold becomes incredibly expensive for institutions. They can get a guaranteed risk-free yield holding U.S. treasuries.
They aren't going to hold gold long-term right now unless there's an active war.
Right. So the mathematical reality is that any algorithmic spike up to that 4,500 psychological level will be met with massive automated institutional sell orders. They will slam the price right back down to harvest the liquidity.
It's a game of financial gravity. But listen, none of this matters. The copula models, the Quasimodo patterns, the macroeconomic yield spreads, none of it matters if you blow up your trading account.
The most important point of the night.
We have to talk about strict quantitative risk management because the diary Kang Bendol source is very clear about survival rules using the Kelly criterion. Let's walk through the actual math on a standard setup so the listener can apply this.
It is arguably the most vital part of the entire blueprint. Let's use the provided baseline example. A $10,000 trading account, utilizing a 1 to 500 broker leverage. Under the absolute mode protocol, your maximum risk exposure is capped strictly at 2% per trade.
And the aha moment here for the listener is understanding why the Kelly criterion insists on that 2%. You don't manage risk just to feel safe. You manage risk because the laws of probability literally demand it.
Absolutely.
The Kelly criterion mathematically proves that if you risk more than 2% per trade, even with a strategy that historically wins 60% of the time, infinite market volatility guarantees you will eventually hit zero. It is the mathematical difference between geometric growth and arithmetic ruin.
Yes, so on a $10,000 account, 2% means the absolute maximum loss you are allowed to take on a single trade is exactly $200.
Exactly 200. There is no flexibility there.
None. Now let's apply that strict parameter to our buy limit trap at 42.50. Let's say we set our stop loss defensively at 41.50. That is a $100 wide stop loss or 1,000 standard pips.
Okay, following the math.
If you were to trade a standard 0.1 lot size, every $1 movement in gold equals a $1 change in your account. So a $100 drop to your stop loss on a 0.1 lot size equals a $100 loss.
But our mathematically allowed maximum risk is $200, so we can double that volume.
Correct. The exact mathematically permitted lot size for that specific $100 wide stop loss in order to maintain a strict 2% risk profile is exactly 0.2 lots, not 0.3, not 0.5, because you have a good feeling about the bounce.
Right, exactly 0.2.
And if you tighten the stop loss to only be $50 wide, the math dictates you can increase the lot size to 0.4. It is a rigid formula, not a guess.
I always compare this to being a sniper rather than a machine gunner. Retail traders are out there spraying and praying, chasing the price up and down the 5-minute chart, sweating over every single candle, trying to force a win.
Which is exhausting and unprofitable.
Exactly. We aren't doing that. We are setting mathematical limit order traps at 42.50 and 4,500. We calculate the parameters, we size the lot exactly to the Kelly criterion, and we literally just sit back and wait for the high-frequency algorithms to walk right into our crosshairs.
It is the only mathematically sustainable way to extract capital from a market exhibiting this level of volatility.
But we have to address the elephant in the room. What happens when the sniper misses? What happens when the math gets it wrong? Because a true professional quant, someone actually operating in absolute mode, doesn't hide their losses or make excuses.
No, they forensically audit them.
Exactly. And looking at the data from Friday, there is a glaring, massive issue we need to talk about.
Yes, the absolute audit. It is non-negotiable if you want to survive long-term.
Last Friday's projection confidently told traders to put buy limits at the extreme support level of 4502.12. That was modeled to be the unbreakable floor.
And as we saw during the Asian session this morning, that level got absolutely violently nuked.
It didn't just break, it was vaporized by a $400 drop.
Yeah.
So I have to ask, how does the absolute mode justify a 95% error level on that specific projection?
It's a vital question, and the post-mortem on the data is very clear. The mathematical model failed because it underestimated a synergistic anomaly.
Meaning two things happening at once.
Exactly. The model correctly calculated the baseline impact of the 5.7 trillion triple witching options expiration. It also attempted to calculate standard weekend geopolitical risk.
Right.
What it fundamentally undervalued was the compounding destructive effect of both happening simultaneously. The combination resulted in a massive liquidity vacuum and a gap down open that completely bypassed all of our technical defenses.
The technicals were completely erased by fundamental panic.
Precisely. The mathematical lesson, the core takeaway from this absolute audit is this. Holding open limit orders over a weekend when there is active, escalating geopolitical risk is portfolio suicide.
Wow.
The model has now been updated to reflect this extreme tail risk. We do not defend egos here. We adapt to the empirical data.
I respect that immensely. You take the hit, you find the flaw in the algorithm, and you rewrite the rule. So what is the new mitigation rule moving forward regarding these new traps we just said at 4250 and 4500?
There is now a strict expiration rule hard-coded into the strategy. All pending traps, both the buy limits at minor demand and the sell limits at extreme supply, now have an automatic time to live.
Like a countdown timer.
Exactly. They automatically expire and must be deleted at 05.00000 IB on Tuesday, which correlates perfectly to the final close of the New York trading session.
Let me make sure I have this right. If the price doesn't hit those specific limit levels during the U.S. session tonight, we just delete the orders and walk away.
Instantly. If the limit isn't triggered by the New York close, the entire price architecture we just built is deemed invalid.
Why is that?
Because the Asian session tomorrow morning will begin calculating a completely new liquidity range based on whatever overnight geopolitical headlines drop while we sleep. You must recalculate the data every single day. You never, ever leave stale limit orders in a hyper-dynamic market. No egos allowed.
Okay, to synthesize everything we've pulled from this late night deep dive, the market is a ruthless, churning interaction between macroeconomics, sudden geopolitical triggers, and algorithmic liquidity hunting.
It absolutely is.
It does not care about your feelings, it does not care about your hopes, or your linear textbook assumptions about safe haven assets. If you want to survive in this environment, you have to trade like a machine. Calibrate your risk to the exact decimal, set your algorithmic traps, and execute without a single moment of hesitation.
And that reality raises an important, perhaps slightly chilling question to leave you with.
Okay, let's hear it.
We spent this entire time discussing how mathematically predictable the retail TANEC was, how the algorithms utilized Monte Carlo simulations and jump diffusion to map a 4 sigma flash crash and a V-shaped recovery purely to harvest stop losses and execute short coverings.
Right.
If retail traders are that predictable, if their emotional reactions to geopolitical news can be mapped and front-run with an 89% probability, are independent retail traders actually participating in a free market? Or are they simply the necessary organic fuel being systematically farmed by high-frequency trading supercomputers?
Wow, that is a terrifying thought to sleep on. Are you an independent trader, or are you just crop yield for the matrix? Something to deeply ponder before you open your terminal tomorrow. On that note, leave the lucky socks in the drawer, stick to the absolute math, and we wish you a highly profitable and entirely emotionless Tuesday. Signing off from this late-night quantitative deep dive. Stay sharp out there.